Good afternoon, welcome, maybe good evening. Right now it is 2 p.m. in Las Vegas. We're live from the Hood Summit. That's RobinHOOD app. And now after a big advisor deal earlier this year, this show fits right into what we're doing with Chicago Future of Finance. It's just not in Chicago, but that's okay. Really, the most important part of the show is the future of finance part. That's definitely what RobinHOOD is about. We're here at all-time highs for the stock, Hood breaking out. We're also here for basically close to all-time highs for the S&P 500. We're right there. Even though NVIDIA slowed down and some of the tech stuff kind of wallowed a little bit in post-earnings malaise, the market is a beast. It's resilient. Yields have dove. Everyone assumes the Fed is going to cut. Bitcoin made a push back above 110, but is still kind of stagnant. We'll talk some crypto in a few forms throughout the show. We got a good show coming up. Brent Kochuba from Spot Gamma is right off the top. We've got Pete Najarian, Kevin Kelly, Noel Smith, Neil Azus, and Jimmy Lee, who's going to tune in as well. So it's a good show. We're going to have a lot of people here, and we're going to have some people remote as well. Let's get Brent Kochuba in, and let's go into the market. Let's talk about the session here underway with the S&P 500 right now. We are 65.12. The intraday high from 2 days ago, 65.32, Brent. The steady grind, the supportive gamma flows. Give me the explanation for why this market's so resilient.
Big level, Oliver, that we mentioned this morning, have been tracking is 65.05. That's the JP Morgan strike, and that strike expires at the end of the month. So if we get above that level or we're near that level, that should be a real stabilizer for equities, at least in the next week, and the big S&P expiration, and of course the FOMC, which is on the 17th. So that's only 4 trading sessions away. And what's interesting at this juncture is 2 things. Number one, Oracle just crushed it after hours. That stock's up 20%. So futures are getting a nice lift off of that. You mentioned Robinhood before and its inclusion in the S&P 500, so that stock is really doing well, getting quite a bit of inflows. Tomorrow we have PPI. The 0DT straddle or the 1DT straddle is pricing that as a total dud. It's basically about $20. So there's no real expectation of volatility around that number. But there is a bit of anxiety around the CPI number that's coming out on Thursday. And so that's kind of the last day or last kind of data point, I think, that can really trigger any kind of a small amount of volatility. But the bottom line here is there's a lot of gamma, vol getting sold, and that dynamic is unlikely to change until next Wednesday. And then next Wednesday, what happens is we have VIX expiration in the morning, then we have FOMC in the afternoon, and then 2 days after that, you have the biggest expiration probably that we've ever seen in history. So a lot of flows are going to shift around that date.
Okay. How come biggest ever in history, Brent? People just trading a ton lately. You mentioned last week, you had that great stat. We had our most 0DTE comprised session ever at like 70%, right?
That's right. Huge 0DT options, and right now that's dominating the marketplace. Why? Because people are waiting on rate cuts. They're waiting on the macro data, waiting on some of that stuff to clear up. And so the 0DT options are essentially kind of looking at a risk-free market at this moment, because what is going to change today, for example, or what is going to change tomorrow that's going to switch up the rate regime? Probably nothing. So a lot of 0DT flows are unlocked in that space, and we're seeing people kind of push into different themes. Google's been a real winner here out of the last few days. Avgo was a big winner, as NVIDIA mentioned, has been kind of contracting or coming in. AppLovin and Hood were recently added to the S&P 500 index. That's coming up in a couple of weeks. So those stocks are doing pretty well. We know it's big flows into financials today. So really big flows into Goldman, JP Morgan, and Morgan Stanley. So there is some asset kind of or stock rotation happening under the surface. But if there's one sign or one thing that I don't like, you can see here on the bottom left is where a lot of stocks are clustering.
Still.
So what's that? Yeah. So that's low volatility expectations. People are not betting on a ton of movement for these names over the next 30 days, but they are put heavy, meaning put prices are carrying a premium to calls. I think that's interesting given the fact that we're at all-time highs. In that we're getting 25 basis point rate cut almost guaranteed. And some people are even saying 50 is now obviously on the table. So you would think that the equity market would want to position a little more bullishly into an event like that. But there seems to be some trepidation there. And the stuff that is bullish is gold, which remains, pretty well bid. You can see there it's on the right. Some of the bond ETFs are starting to catch a little bit of a bid as well. So people are kind of positioning around this changing rate regime. So it's very strange. People are pricing in very low volatility over the next week at least. But they are not piling into calls here as we are at all-time highs. Now, Oracle, which just crushed it, maybe that changes the tech dynamic here a little bit over the next week or so. But, bottom line here is over the next week, not expecting a whole lot to happen until Wednesday. And then Wednesday, you get the rate shifts as well as a lot of position shifting. And to me, that's where the volatility will start to shift and stocks will really start making big moves.
And if it goes the way folks hope, then most of our flows supportive, I assume. I want to go back just real quick, Brent, into the trace. Take us through again what you envision could happen next week if all those dubs do align.
Yes, last week we were talking about the possibility of 1% to 2% upside in the market until the next week's FOMC, excuse me. And so we're right about up 1%. I think we could easily get into the 65.50 area because there's a bunch of positions in that general neighborhood. You can see how that map is bright blue above us, right? That bright blue is resistance. Not resistance as in like sell off, but resistance as in stuck in mud. We've been calling this the zombie market here, or the zombie period, where vol's just kind of grinding. Very tight range yesterday. We only had a 30 bips range yesterday. Today was a 50 bips range, meaning that the market is just not doing much, right? The S&P is just not doing much. And there's these big condor trades that are coming in and kind of trapping volatility. We saw that again today, huge 0DT condor flow. So these short-dated flows are just keeping a straitjacket on this market. And all that's, I think, is just going to set to release next week. So right now we have 65.50 is, I think, squaring up to be, probably the key upside level. Maybe 6,600 if CPI is just really in line and people squeeze us a little bit more. But that's where things started getting really toppy in terms of the options positioning. So, maybe another 1% here over the next 4 days.
Perfect. Great analysis, and the steady grind has been the narrative. Been spot on with that. Thank you, Brent. Good stuff.
Thank you.
Appreciate that. Nice look from Mr. Spot Gamma there. By the way, 50% off. Scan the QR code at the top of the show and through the conversation. Let's talk some more 0DTEs with Mr. Kevin Kelly joining me here at Hood Summit. Kelly Intelligence and Portfolio Managers, some very fun funds. I know you couldn't hear Brent there, but I'm going to just repeat what he said because I don't know how super plugged in you are like the market on the short term. I know you always are, Kevin, but he said basically the short dated flows that kind of have us in a straitjacket. That is a good one. To our own benefit, we just keep steadily grinding higher. And 70% of volume last week was 0DTEs. So tell me how that fits into what you're looking at, because you have funds that use 0DTEs. Connect that into the market, what's happening right now.
Yeah, and we've seen that this has been a long tailwind of using 0DTEs in portfolio management. I mean, we've seen it grow from 30% to 50%. Now we're up to 70%. Everybody's going short duration, right? The shortest duration they possibly can. And if there aren't 0DTEs, they're going into the weeklies, right? So if you look outside of 0DTEs, people are going to be using the weekly. So I would presume that actually the vast majority of what's left is those weeklies. And that's because volatility is the realized volatility has not hit the implied. So implied volatilities are still relatively elevated to the implied volatility. So that's why people are moving into shorter duration, because there's quicker moves and they're reacting faster. Think about tariffs. I mean, you couldn't even wait for the data to flow through on the economy or companies before we rebounded. Right. So I think the way to think about it is they're great risk management tools. And so,
which is the way you think about it, which is important because there's some people who think about it on the other end of that. Right. There's a lot of people here who some of their biggest trades have been catching those moments where the realized vol catches up to implied. Right. And they kind of surf. That's a lot of what Brent does. You're looking for, or how folks can use his data if they want. I know his personal trading, but you're watching, you're waiting, kind of trying to surf, catch a big wave. But what you're saying is that from an institutional standpoint, which is effectively more your role as an ETF manager, provider, et cetera, that you're using it because it completes the vol surface, and that you almost can't not use them if you want to be properly hedged.
And I think the way to think about it is you can use them shorter duration and you can roll them so you're not using as much premium. And so what you can effectively do is use, especially 0DTEs on the put side, you can use them as a great tool to protect your portfolio. Say you're long a huge position in semis, right? AMD or NVIDIA or what have you. You can actually use 0DTEs on the downside and roll them for a little bit longer, and they actually serve better than these 3x products that are out there to the downside. So you have a lot of ETFs that are out there that can give you 3 times
the beta. You're talking about the pure beta stuff out there.
Yes, exactly. But then if you get caught on the wrong side, you have unlimited risk, right? But on zero DTEs, you have defined risk, and you can do that over multiple different days. So I think that's what the interesting aspect. And going back to catching kind of those big moves that you described, that's also risk management, because if you're only going to outlay a small portion on buying a zero DTE call, let's say, for example, and it doesn't hit, you only lose that premium that you paid, as opposed to being long just the beta or the stock or whatever it is. That could be a larger capital outlay. So you could have more of those, I guess you could say, bets or positions out there.
Now, this obviously gets right into product talk. Daily deltas, zero DTE, long options.
Yeah.
This is attached to the NASDAQ 100.
Yeah.
Ticker Q up and Q down.
Correct.
So this is talking to a similar a bit about what you're saying here, right? I mean, this is not, how does this kind of compare to the other fund we've talked about?
Yeah.
That is the crypto funds, Biddy and Baggy, to take the volatility of a very volatile asset and wring income from it. You're doing something similar with Q up and Q down with the zero DTEs, or what's kind of, how do those strategies differ from taking something and using options to generate?
That's a great question. That's a great question. So on Q up and Q down, all we're trying to do is have the zero DTE on to capture the market move as much as we can for that day, right? So we're trying to get leveraged returns on the upside or the downside. So you're leveraging your beta, but doing it through options premium, okay? But on the crypto funds that we have, on the Bitcoin funds, we're just trying to monetize volatility. We're getting that theta decay. So we're selling 5% out of the monies that are weeklies, and letting that decay over 5 days and capturing that options premium. So it's a little bit different.
So do you do any of the zero DTEs in the Bitcoin stuff?
No, we don't do any of that because on a 24-hour traded global asset, that we want to stay away from that, right? So we're doing
clock
weeklies.
Start and begin?
Yeah, so Friday to Friday, right? So we're letting that vol decay down over a week time period.
Well, that's what's kind of interesting, because they're very different in that sense, but they're kind of taking different parts of the volatility spectrum, right? You're counting on the theta decay for the Biddy and Baggy, but here in the zero DTE realm, in certain cases, you're comfortable owning premium. Right?
And that's all we're trying to do. So Q up and Q down are trading tools. And so every day we're going to spend that options premium. And so the way to think about it is we're targeting about 4 times the amount of returns of that daily return for the Q. So if the Qs are up 1%, we're targeting and trying to get 4%, right? And if Qs go down 10%, we're only going to lose that options premium. So it's a risk management tool that we could own during volatile time periods or hedge for earnings events, and we're capturing the overnight. So we put it on at the close, and then we'll have it through the next day's close. So you will capture the overnight moves in the markets, because we see a lot of events
that happens overnight,
and in the morning.
By the way, so last point here, which is, we just had this conversation with Rob Baldwin from Trade PMR, custodian of $45 billion of advisor money that Robinhood bought earlier this year. And the idea is, you've had, the way he put it, which is very much kind of the advisor, is, trading's kind of a young man's game, right? Or you've done so well, now time to get an advisor. My point was, all right, well, a lot of these people got to where they are because they were slinging options or doing something fairly active. Are they really going to then start buying buffer funds? I would guess what you might be able to pitch is like, hey, let me do a little bit of slinging for you. Is that kind of the idea?
Yeah, so the idea here is we're just trying to provide tools for portfolios, and so Q up and Q down.
You buy and hold it.
No, Q up, Q down. You do not buy and hold. You want to own it. They're because they reset daily, right? But here's why you use.
So they still got to do some slinging on their own.
Yeah,
this is just a tool to.
Well, here's the thing. They could be trading a bunch of the different names within the Qs that are going to move the market, but they can just set this on knowing that we're going to every day. So they could hold it for 5 days, 10 days, 30 days, knowing that they're going to have puts on and protect themselves, or calls going up. So for them,
they can freely trade their tech.
Yeah,
and they can have this little kind of hedge
on the opposite side, right? Yeah. So say Nvidia is going to report earnings, but they already own too much Nvidia and they don't want to worry about it. What they can do is just own Q up, because it's going to move the Qs any which way, right? And especially for the Qs, think about it. disruption is an ever-present, omnipotent phenomena that's there every day. So these are great tools for them, so they don't need to manage their options, positions, and margins or whatever. They know what they're getting with our products. For the Bitcoin products, right? Bitty, baggy, for them, it's just like, hey, let them scalp the premium. Let them do the professional options.
Passive.
I'll collect the options premium every month, and that's what I want to do.
Love it. Got a little something from everybody.
Yeah.
For everybody.
Yeah.
Appreciate Kevin. Always fun.
Thank you.
Innovative stuff. Always like the use of options and giving folks ideas and hear people thinking about trading too, or taking something really volatile and getting income from it. Let's go into the future of finance of event contracts, which is obviously something big here too. It's time for the gamble. All right, we got Mr. Pete Najarian with us here today. Pete, I feel like we should knock out the sports stuff first because even out here in Vegas, everybody was talking about the Bears yesterday. Why is that?
Well, because of the fact that they collapsed in the second half, especially in the fourth quarter. I mean, they gave
I'm going to apologize to the guys, too. We're putting salt in the wound here. Bears just fumbling it again.
Yeah, but, 21 points in the fourth quarter, that's something you just can't do. That's part of the NFL is you've got to play on both sides of the ball, of course. And the Bears looked great for a portion of the game, although they had the interception for the time. I mean, there was a few mistakes here and there, but overall, they looked good, right? Until they gave up 21 points in the fourth quarter. Then they didn't look good.
Yeah.
Against the Vikings, by the way.
Not a good look. Pete, how did you were talking about how you were looking at the kind of young quarterbacks versus old. How does that look after week one, that kind of thesis we talked about last week? And
I am so impressed with the young quarterbacks along with some of the middle veterans. And then, of course, even the veterans. I mean, all you got to do is look at what Aaron Rodgers was able to produce, 34 points. Now, again, it's against the Jets, who are not a great team, but nonetheless, he had to step up to the plate, and he did. The guy threw 4 touchdowns. He's what, a little over 40 years old or whatever. So the old men and the young guys, I'll tell you what, I'm excited about a lot of these young quarterbacks. I think that they can change the complexity of what the team really looks like, because of the fact that some of them are so good, they're so prepared, and they're really, truly ready to be in the NFL. Even though they're rookies or second-year guys, these guys are absolutely impressive to me and how they've stepped up already.
Pete, what do you like? What's big in your mind for sports over the next week? Is there anything that looks juicy to you in your trading?
Yeah, well, I think that there's a lot of different. I'm a football guy, of course, and I absolutely love it. And I follow the Big Ten because I played in the Big Ten. So I think that there's a lot of interesting things going on in the backdrop right now. Michigan losing to Oklahoma was a big surprise last week. Ohio State still looks fantastic. But then I look over at Nebraska. Nebraska's got some young players. Now, they haven't played anybody yet, but Nebraska's got some young players that I think really could step up and turn them into a team that are they going to go undefeated? Absolutely not. But are they a team that is on the rise that I think is going to get higher into the Big Ten by the time the end of the year comes? Absolutely. They've got the quarterback back. They've got offensive line. They've got defensive line. They've got some great DBs. This is a really good, well put together football team. And I think Rule is a pretty damn good coach. So I think those guys will do just fine.
All right, Nebraska at 99 cents right now versus Houston Christian. Hey, there's always 1 cent to ring out, I guess.
Right.
I went to the UNLV game here, which was pretty great, pretty amazing stadium.
Yeah.
And they were looking pretty good too. That was pretty fun. I mean, it feels like there's a lot, obviously, in college that is. Do you feel, Pete, as far as football betting goes, pro versus college, that you find yourself veering more one way or the other? Is there more volatility in college?
There is a little bit more volatility there, and obviously, you don't have all of the protection you do as far as the NFL is concerned in terms of the backups. The backups are really high-end backups at the NFL level. College, you don't know if the guy's a freshman, he's never been on the field, and all the rest of it. So, with the young guns like that, that's a little bit of a different thing. We're talking about 17, 18-year-old guys. So if you get somebody hurt or they miss part of the game, that is a much bigger deal, I think, at the college game. But I still love it. I mean, I think college football, there's something about that is a little more exciting for me even than the NFL.
Yeah, love it. Let's talk some markets here. Let's talk some economy for a second, Pete. One thing that I was looking at, if we take my screen on Cal sheet here, Matt, unemployment in September, after some of our data last week turned soft, I think a lot of folks were expecting that number to look decent, and it missed pretty notably on employment.
Yeah.
Odds for 4.4%, technically not, 4.3 is where you can set the line right now. 4.1, 4.2, 4.3. All those odds basically went up since last week. Pete, do you think that that's warranted after the number we saw?
I do. I absolutely do. And it's not only the number that we saw. What can we believe these days? By the way, I mean honestly, when we look at some of the numbers, it's one of these things where we really shake our heads. But I think that the reality is that there is some negativity out there, and I think as we dig a little bit deeper, could we go a little bit higher? We could. We're already above where we were the first time since 2021 that we're at the level we are, but we're still well off those averages of the past where we're talking about 5.5, 5.6%. We're at a 4.3 right now. Should you worry? No, but I think that we got to keep a pretty close eye on it.
Yeah, the possibility that it goes down notably is very close to zero here. Kalsh is saying it's going to be above 4.1%, at least at 95%. I know that a few of the other things we talked last week, I wanted to check in with you on, Pete. Tesla versus the precious metals. Which of those trades is more interesting to you this week?
I always like the Tesla trade, of course. I mean, it's just exciting. But I think that the reality is, this is the Burl Ives trade, because you've got silver and gold, and both of them have been ripping to the upside. They're up 41, 42% on the year to date. So pretty daggone impressive. And we continue to see even more option activity coming into gold right now. We see a lot less in silver, but gold, the GLD specifically, has been a great tool. And it was trading a little bit below 340 today. But they came out and they decided to buy 80,000 of those calls, and they spread it off by selling the 355s. It's a $15 call spread to the upside 80,000 times. I think they're looking for this to continue on. The fact that gold has already had a great start to the year is pretty impressive. But I think that what we're seeing right now is they're expecting gold to continue to move to the upside. And we're not that far from 3,700 yesterday, and we weren't that far today. We pulled back a little bit, but I do think that we're going to see gold get up there and actually get through there, probably not too distant future from now.
The gold move is very impressive, especially considering all the call buying that you mentioned. If we look at my platform here to look at this GLD chart that exploded higher, give some context to those strikes Pete was talking about. We're at 334 right now. And Brent's analysis from the spot gamma flows data also shows, as we've looked at several times in the last couple of weeks, that there is significantly more upside call buying and positioning generally in gold, even than there is in the broad market when you look at things like option skew and other metrics. So I guess that's just what happens when you get a breakout move like that, Pete. Or, how come we're not seeing the same type of confidence in the stock market? Maybe just a slow grind works there.
I think you're right. Although, let's be honest. I mean, there are a couple of different sectors right now that are absolutely ripping to the upside. One of them is the financials. And I think a lot of that has to do with my biggest reason for why they're going up as well as they are. That everybody can have whatever they want for their reasons. But I'm going to say it's the investment banking side. And I continue to come up each and every day with John and I do this little podcast that we do. And I can tell you, it's absolutely incredible to see what we are seeing going on in terms of the moves that we're seeing. It's absolutely incredible. So where do we stop? I don't know, but I look at the financials at all-time highs as far as the XLF is concerned, and I look at the same thing when we look over at the communications names, and there's really four in there. You've got the two Googles, and then you can add in a couple others in there like Meta and maybe Netflix. And when you put those four together, you're talking about almost 50%, and that's near all-time highs as well. Absolutely just flying to the upside. And I'll tell you what, I don't know that a lot of people were on board with Google, but they probably should have been. And we continue to see option activity in that one as well. They continue to buy upside. They continue to think that Google's not done yet. And if that's the case, then we're going to see the communications ETF go even higher.
Wow. Yeah, good eyes on that. Nice. Google, what a trade. Good eyes on that, maybe being a propellant for XLC to keep going. Big break out there. Pete, always great conversation, nice variety, good breadth and depth. Thank you, sir.
I really appreciate it, man. Have a great one. We're going to get those Bears a win soon. We will.
Right, I know. People are talking about it out here in Vegas. I love it. Thanks, Pete.
All right, thanks.
Let's do a 60-seconder. I got Noel Smith sitting down next to me. Let's come back, get into some more options, weeds. Last time we spoke with him, we talked variance futures. So maybe we'll recap that for anyone who missed it. Be right back. There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. SIBO is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from SIBO, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to Chicago Future of Finance here in Las Vegas. And following us, this is nice, Noel Smith from Convex Asset Management talked to us while we were in Chicago at the SIBO. You're based in Vegas, Noel. We got a little rowdy on the mountain, and luckily we found a nice, comfortable space for me to put my busted up leg. You're a savage on the mountain bike, Noel.
That was fun. I mean, I'm glad you're not hurt. I was surprised I got that crash on video.
Yeah, I'm just fake hurt. I'm not real hurt. Tell me about the update from our last conversation. You told us about how you use variance futures because you really like to monitor dispersion in markets, and that's one of your core strategies that you have. What's going on with that? Is anybody catching on to it? Is it still a pretty small market, or how is it working?
It's still pretty small. There's not much liquidity. Variance futures can be used in a dispersion trade as a way, if you have, say you have a short straddle, and that straddle is struck at, 6,500, okay? But as you go away from strike, your options either go to 1 or 0 delta, and you have to restrike it. Or you're doing strangles, same problem. You have to do a strip of options. What variance futures can do for you is take that risk out of the book. So say you're short variance futures in lieu of being short a straddle. You can collect the realized variance as a function of what's happening in the marketplace compared to, say, the options strip or the options straddle or strangle.
Okay.
It allows you to really do the trade a little bit more cleanly, which is one of the reasons that we're looking to do that.
When I think about who's here, what they're doing, there's a couple big themes. Obviously, Robinhood trading is one of them. And a part of that, in the trading world, obviously, Chicago Future of Finance, we're talking options a lot. What's the type of person you think has utility with variance futures? Do you really need to be operating on a very fast kind of institutional basis, or do you think for the everyday person that these tools should be something they start to learn about?
It's absolutely something everybody here. If you're trading options, you should know what variance is, because it's the same thing with the different, algebra equation assigned to it. So the idea that you wouldn't understand variance, but you do understand volatility, doesn't make any sense.
Yeah.
So it's absolutely something you should think about. So the idea that you can use this product as a way to hedge your book, express anything really, anything you want to do in volatility on an index level. You can't do it for individual names like Google or Apple or whatever. But if you're trading index vol, you should at least know the product exists and how it might also suit your book.
Well, if I take it at its face label, variance futures, and how you use them to hedge volatility, as a poker player in Vegas, who I got wrecked this weekend. These guys are not messing around. But you know what I say, because it's true, it's bad variance. I can't fold kings. I came to Vegas, right? I got pocket kings. What do? The variance is that he had aces, right? Actually, it was she had aces. So if you're a poker player, the mindset, if that's variance, and the professional players will say, I'm down because I'm having bad variance. If you can hedge variance in any way, taking it from the poker analogy, it sounds like a powerful thing.
Well, it's really simple. From a hedging standpoint, if you are long variance futures, you will collect the realized variance over the duration of that contract. And you can figure out for yourself, do you want to do that in variance space, or do you want to do that in VIX space with maybe VIX calls? Because a lot of times when people are hedging now, they're using downside puts in SPX, or they're using upside options in VIX. And variance might end up being a preferred product for that, depending on what the market actually gives you.
Tell me about how you're thinking from the advisor side, because that's the other big theme here, is that Robinhood now has millions of clients, and because of the trade PMR deal, there is an advisor side to this story they will see it as a compliment. I think many people will. You've built up this portfolio trading. Now, what do you do with it? How do you think, as an options trader in your own strategies, what fits in that world right now?
Sure. So we've been given an opportunity at the firm level to take some of our IP and our proprietary algorithms and apply them to some of the things that are happening in the RIA space.
Okay.
So what people are doing currently with options is they're selling options as a way to create yield, income, whatever you want to call it. And if we basically apply our IP with some of those strategies, we think we can have a net better product. And what we're looking to do is deploy those ideas and give them to the RIA space so they can have a different, better version, improved version of what's happening right now, which is selling options. We're doing it more opportunistically as opposed to just constantly selling options to the marketplace kind of naively.
Is that the kind of the standard where advisors go, we'll do a call spread, something like that?
Sure.
Is that kind of like
there's nothing wrong with
you
the
want
call
to give them
spread.
something a little bit?
Would you rather sell a call spread when the stock's going up or down? I'd rather sell it when it's going down.
Yeah.
And having some kind of second level or third level intelligence as to what's going on in the marketplace, as opposed to just blindly selling options into the marketplace, the math supports it's just a clearly superior strategy. There's no reason from a math standpoint you wouldn't want to do that. So if you can put more chips on a better bet and take less chips off, it's a worse bet. It's very simple.
How much of do you bring the structure to do this over, or do you find that advisors generally have the capacity to go in, have the tools they need to trade options, or have some kind of way to understand, margin, how that changes the risk, how that changes the relationship with their clients? Is it easy to take something and layer it onto that, or do you find the advisor needs to start building that capacity up before they layer in someone who's going to do something like this?
It's going to be more of a case-by-case basis. I don't think there is any one-size-fits-all answer to that question. But I will say, the point of the business is to make it as simple and easy for the advisor. If they can see something like, okay, we're getting 9% to our customers now, can we turn that 9 into a 12 or 13 with a de minimis amount of risk added? I think that's a compelling argument that anybody would want to listen to. And that's exactly what we're trying to achieve.
All right. No, great to have you here. Great to see you in Vegas.
Welcome to Vegas.
Thanks for the ride. That was fun.
Of course.
All right. Appreciate the thoughts on the market as always.
Thank you.
Noel Smith, Convex Asset Management advisor coming up. Neil Azus joins me from Rare View Capital. Also some ETFs in the shop as well. 60 seconds right here from Hood Summit in Vegas. Welcome back to Chicago Future of Finance, live from Las Vegas at the Hood Summit. We're talking trading, we're talking markets at all-time highs, a lot of advisor discussion as well. Intercene Neil Azus here, an advisor managing more than $500 million under Rearview Capital, based in Las Vegas. Great to have you here, Neil.
Oliver, good to see you. We go back a long ways.
We do, and it feels like worlds are colliding here. You know, it's trading, it's options, it's the advisor. I think a big theme of this is people did really well during and since basically COVID, trading for the most part. And now it's kind of how do they work that money into a sustainable way where the advisor comes in? How are you thinking about that in your business?
Sure. If you're a financial advisor and you think about options and you just have a starting point that when you sell an option, by definition, you win 3 out of 4 times.
Yeah.
And when you buy an option, you only win 1 out of 4 times. So if you start with that premise and you think about it in a yield enhancement framework, or collecting income, if you will, or what they call buy rights or overrights, there's definitely an advent of that in a portfolio for sure. If it's day-to-day speculation or earnings announcements, I think you have to have a professional approach and know what you're doing. Otherwise, it's a recipe for a challenging time.
Yeah.
But they definitely belong in portfolio construction for sure. And it's incredible to see over the last 4 or 5 years through this organization and others, the proliferation of them and how many people are smart and being involved in it and things like that. It's very different from when I was an options trader, back in the day, 25 years ago. So it's encouraging to see.
There's a wonderful answer. I think the Restream app we use to stream this out, the AI picks clips for the show, I think it's going to pick that response because you really hit a lot there that this show's about, Chicago future finance. I mean, it's future finance everywhere, but the Chicago part implies that options, part of it. But then, of course, advisors are everywhere, national in scale, huge amounts of money. And the way you put it, to think about it as the most baseline of thinking about the probability of selling options versus owning options is the starting point. What kind of educational kind of hill do you think advisors still need to climb on average? Do you think there's a lot of education still needs to happen?
I do. So I think of advisors as one cohort. There are day traders or people that are self-directed or learning as a different cohort. They actually tend to learn much quicker than the latter because they're dedicated to it. They're trading it all day. Financial advisors have lots of things on their plate. Options are one of them. So if they're serious about integrating them into portfolio construction, I absolutely recommend 1 or 2 books probably. The names of them are elusive, but I certainly have them on my shelf.
Yeah, probably know some of the guys.
And then secondarily, I think the educational websites at the CBOE, their sister partner peer organizations have great libraries, videos, education departments. They're wonderful things. And if there are any financial advisor that has a linkage to a large Wall Street bank, they all have education classes, including 1 or 2 weeks in person.
Yeah.
Strongly encourage those to get educated.
Great advice. Great advice. One of the other things that kind of overlaps somewhere with that theme of using options to bolster a portfolio or have something to offer to a younger generation. A lot of this is about succession planning. Where does an advisor money go? How do you appeal to people? You can appeal them through options. You can appeal them through crypto, through alternative asset classes. Last time I saw you was with Matt Tuttle, where you guys were launching BEGS ETF. Right. Do you see that as a vehicle for also kind of augmenting people's strategies, their portfolios?
So in general, if you run a globally diversified portfolio or a multi-asset portfolio, typically about 4 to 6% of it has some bent towards commodities. Okay. In the case of the product that you just referenced, the strategy that we run, that includes both precious metals and digital currencies.
It's Bitcoin, Ethereum, gold, silver.
That's right.
BEGS, BEGS,
That's
up
right.
45% on the year.
It's doing quite well.
And because they play off each other very nicely. Bitcoin and gold, I've seen the math on that. And so there's, I would assume, silver and ETH to some extent, but those are pretty new still, right?
The way to think about it is easy. If you're running a global multi-asset or globally diversified portfolio, commodities are a leading instrument this year, led by precious metals and digital currencies. If you want to keep up with a benchmark, you likely have to own some version of that. And then the top 3 or 4 or 5 of those inside the entire world at the moment across all asset classes are the instruments that you just highlighted. Gold, then silver, then Bitcoin and Ethereum. So if you want to be in the race, you got to bet or own the winning horses inside the race. Those are 4 out of the 5 or so for sure. And I think the real issue is that most people don't have that. Certainly they have a 60-40 portfolio, but multi-asset also includes commodities, credit, and cash. And all assets are melting up, and they're having a substantial outperformance over the traditional industry-dominant portfolios like 60-40. So you definitely need them. I think it will continue. It's nothing to be about, I'm an evangelist for precious metals. I'm a believer. I own them. I think there's a place in portfolios for all of them at the right increments. And you need to have exposure to the horses that are winning.
And again, the math on gold and Bitcoin is pretty good. They oftentimes complement each other. When one is down, if Bitcoin is down, oftentimes gold is solid, and then oftentimes they're up together too. Whereas ETH and silver, I haven't looked at that part, but again, it feels like it's probably analogous to some extent. If you are used to looking at ETFs, you're going to see a fee of 1%, gross total 1.2, right? But is the idea then, hey, this is something that's going to have alpha on top of it that makes up for that?
Yes. So if you're talking specifically about fee structures, right now that's not a dominant conversation in the industry, although always important. Everybody should always read the fine print, understand what the expenses are. But if an industry or an index is up 8, 9, 10%, and those instruments are up 30 or 40%, that's less meaningful right now. But in terms of longer-term financial planning, that's always important. I think when you look at these types of instruments, you probably want to take three things into consideration. One is there are differences between all of these products out there that are 2 times daily reset. You take the risk from 4 p.m. the day before till 9:30 the next morning, and then they have to change or adjust their portfolios with leverage. That has a mathematical impact that leads to significant tracking.
You're talking about the options-driven strategies.
Any 2 times levered product.
2 times levered, okay.
Borrowing money to get 2 times the exposure, but have to reset it or do a trade every day. The other concept being return stacking, which targets a certain asset, has significantly or substantially less tracking error if you are looking to use leverage, such as the strategy that we deploy. The second part speaks exactly to what you said a minute ago, which is what they call diversification. How do you get to that? You look at the correlation between Bitcoin and Ethereum, gold and silver, and then you look at those 4 also against the S&P 500. And in both instances, they're very low, meaning digital currencies have very low correlation to precious metals, and both asset classes have low correlation to the S&P 500. That makes it an ideal utility to add into or layer into portfolios for that, meaning one day Bitcoin could go down substantially for whatever the reason is, but gold could stay flat or even appreciate on that day. That's what you're looking for. You want independent positions when you add in different instruments.
To that point, kind of the last thing maybe is, and I'm not, people know I'm not like a crypto evangelist by any means. However, when you look at the correlation point, that correlation did subside a little bit in some key moments this year with stocks. But I think if you still pull back in the history, you're going to see a decent amount, maybe after, let's say, the futures listing of Bitcoin, when it became kind of more deeply liquid, generally have a pretty strong beta tied to the stock market. I wonder if Bitcoin accomplishes the risk part of the portfolio, can a Beggs type strategy that combines these commodities or alts together be a one-stop shop for people? Can they think about it that way?
That's exactly how we think about it, is that you get a one-stop shop all or a basket trade, or if this was a craps table, since we're in Las Vegas, you get the field bet, right? At the same time, you have this reduced correlation between precious metals and digital currencies. And if you're intelligent or thoughtful about how you weight those instruments, meaning gold is 3 times less volatile than Ether, and silver is 3 times more volatile than gold. And so if you structure it or volatility weight it, you can have reduced overall contribution to a portfolio, which is what you're looking for. And so, yes, I think that has legs. And I think the easiest way to think about it, Oliver, is that between now and the end of the year or sometime in mid next year, the big custodians like Charles Schwab, Fidelity, they are allowing this to be on their platforms. And there's 100 million accounts that may want to go dip their toe into the water. And that may feel like 10 pounds of bologna going into a 2-pound bag as everybody looks to get some exposure. This is really a simple access product to go do that. You set and forget it. It's thoughtfully weighted, diversified correlation, and a better outperformance than the 2 times daily reset because of the return stack.
Got it. The return stack, the more preferable structure there for keeping your margin. All right, BEGS, 46.6% on the year. Neil, great thoughts on the advisor world, the options stuff too. Fun convo.
My pleasure.
Great to have you here.
Having me.
Absolutely.
Nice
yep. Thanks for coming. Can we hit the risk radar? We got a graphic real quick to close this thing out. A few final thoughts here on the stock market.
Sure.
Given that we're ripping, if we pull it up, we're going to look at basically the exact same thing that we've been seeing now. I've had the green light on stocks holding. It's still there. The one thing I'm looking at that's been curious has been the dollar a little bit. Dollar kind of firmed up again, but generally it still remains heavy. Now, what I'm watching for the dollar at 97 is basically if we go back and revisit the lows. The reason I'm watching the dollar is because of the narrative around the Fed cuts and the fact that the 10-year yield took a big drop. That tells you generally that the dollar's probably going down too. The move in the 10-year from last week around the employment data was much more profound than what we've seen on the dollar, which has been a little bit more resilient. So I'm looking to see if the dollar maybe needs to go deeper, close to the red, where it's been yellow. But the bonds too, I think, are going to have to flip probably green and push into that territory soon. So we'll revisit that tomorrow, but the Treasury breakout looks pretty strong from the last couple of days. Bonds getting a tiny bit back, but stocks having a real good session as we got the S&P 500 at 65.12. Thanks for tuning in to the Hood Summit here in Las Vegas, to Chicago Future of Finance. Don't miss tomorrow's show. It's going to be a really excellent look, a deep dive inside SIBO, some of the smartest people at one of the most important financial institutions, continuing some of the big themes from today. You know we're going to be talking a lot of options tomorrow. Have a great night. I'll see you at 10 a.m. tomorrow, Pacific time, right? 10 to 11.